In this lesson, we're going to begin going over our Advanced Financial Modeling course and the Microsoft Yahoo case study. We're going to begin by going through exactly what we mean by advanced modeling and what you're going to learn in this course, and then how we're going to approach the operating model or three-statement model for Yahoo. Once we get through all that, then we're going to jump into Excel, and I'm going to show you exactly how to set up your own Excel so that it works correctly, so that you have the correct settings, and so that your inputs page, the first critical part of the model, is set up correctly. So first off, what exactly do we mean by advanced modeling, and how is this different from the fundamentals course if you've been through that, and also how is it different from some of the industry-specific courses on the site if you've been through them? Well, the first major difference is that in the advanced modeling course, we're going to be really focused on the mechanics as opposed to the concepts. So in this course, I'm assuming that you already know, for example, how basic accounting works. You already know what an income statement, balance sheet, and cash flow statement are. You know how to link them together. You know how to value companies. You know how to create merger models and LBO models. So I'm not going to go through and explain what all those are in detail. Instead, we're going to focus on how, in real life, when you're working at a bank, you actually work with all those concepts and you use them to model and value real companies. Since we're going to be very focused on the mechanics, we're going to rely heavily on companies' SEC filings or equivalent government filings abroad in other countries. We're also going to rely on equity research issued by investment banks when we come up with projections for these companies. So we're going to stick very closely to reality and try to base as much of our analysis as possible on what banks in the real world actually do. Now, I mentioned just now that we're going to emphasize mechanics over concepts, but at the same time, there are also some trickier concepts within this course as well. For example, in the fundamentals course, we didn't really deal with the concept of equity interests or associate companies, and then the corresponding concept of non-controlling interests, cases where a company owns more than 50% of another company and has to reflect the portion that they do not own on their financial statements. We're also going to get into more advanced concepts such as stock versus asset versus 338(h)(10) purchases, and in the LBO model we're going to look at several different types of debt that we did not get to in the fundamentals course. Now, none of these concepts is particularly difficult, but they are trickier to understand, and they do require more advanced knowledge than what we went through in the fundamentals course. As I mentioned before, we're going to be relying heavily on SEC filings and equity research. In the fundamentals course, we also used filings and research, but the difference is that we didn't stick as closely to what they had there. We had them more as a reference, and we had them in case you wanted to go and do your own work and go through them in detail and look at them and see how they matched up to our statements. But this time around, we're going to be relying on them in all parts of our analysis. The other difference is that we're going to have a lot more supporting detail this time around. Whereas in the fundamentals course, we might have relied on revenue projections like 10% or 15% per year and left it at that. This time around, we're going to go into different segments of revenue, different divisions of the company, Yahoo here, and see just how we build up a company on a division by division basis and look at each segment of their revenue separately. When we get into our depreciation and capital expenditure estimates, we're going to actually create a PP&E schedule that shows exactly where each segment of the depreciation and capital expenditures are coming from. One thing I want to emphasize here is that these details are not critical to the model. In other words, in the final output, some of these details are not going to make a tremendous difference. But the reason we're doing them is because in the real world, when you go and present revenue growth to a company, and they're a client company or you're presenting to an acquirer, they're going to want to see the backup and the detail behind how you got to that number. So you can't just go out there and say, okay, we're going to grow at 20% or 15% this year. You have to go out and say, we believe that we're going to sell X units at this price and that unit sales are going to accelerate by this much and that we can increase our price by this much. And you have to have some kind of detail behind it. So many of these extra details we're going to get into do not actually affect the output that much, but we need them because we have to be able to justify exactly what we're doing when we present to our client or when we present to potential buyers in this case. And then finally, it's also going to be much faster paced than the fundamentals course. And again, I'm assuming that you already know a lot of these concepts. I'm not going to slow down here to explain exactly where we get every single number within our model. A lot of the numbers and a lot of the information will be pre-filled because I don't want to waste time on data entry. You can go learn data entry on your own. You can look at what I'm doing and fill it in yourself if you want practice, but I'm not going to spend a whole lot of time explaining basic concepts, nor will I spend a whole lot of time here on data entry and copying in numbers from filings. So what are we doing for our case study here, and how are we going to approach this advanced modeling course? Well, first off, we're going to start with an operating model, or a three-statement model for Yahoo. We're going to go back in time to 2008, the 2009 timeframe, when the Microsoft Yahoo acquisition was on the table. Now, of course, we know that after the fact, it fell apart, it never came together, but we're going to go back in time and pretend that Microsoft was actually potentially acquiring Yahoo and see what would have happened. Now, the first step in that is that we have to go in and look at Yahoo's financials in detail and create a detailed three-statement model for Yahoo. We need that because later on, when we merge them with Microsoft, we need to figure out what the combined company is going to look like. If we don't have detailed projections for Yahoo, then we cannot do that. Next, we're going to be valuing Yahoo. So essentially, we're going to be pretending that we're investment bankers who are representing Yahoo in this deal. We're going to value them and see what a fair offer or a reasonable offer for Yahoo coming from Microsoft might look like, based on public company comparables, precedent transactions, DCF, and other methodologies. And again, the concepts here are not tremendously different. The real difference is that we're going to be relying a lot more on SEC filings and more on the nitty-gritty details of all the add-backs, all the non-recurring charges, and all the other hidden behavior and hidden financials that are contained within a company's statements. Then the third step, we're going to pretend that Microsoft actually acquires Yahoo. We're going to build a full-blown three-statement merger model that combines all the statements and looks at a variety of advanced scenarios here and actually analyzes what kind of EPS impact and what kind of impact on Microsoft's financial statements Yahoo would have made had they actually acquired the company. And then in the last major segment, we're going to assume that KKR or another mega PE fund, in a case like this, a deal like this, it's going to be so huge that most likely multiple firms are going to have to come together to pitch in for a deal like this. We're going to assume that they actually buy out Yahoo in a leveraged buyout transaction, and we're going to look at the IRR, the returns, see what it looks like, see if it's actually a viable transaction for them. We're going to get into a lot of detail here and go into the LBO model in far more detail and go into different scenarios, different types of debt, and a whole lot of other things like different transaction structures that we did not look at in the fundamentals course. And then finally, we're going to look at some other more advanced topics throughout. These don't fit into a particular category, but as I mentioned before, some of these topics will include equity interests, non-controlling interests, otherwise known as minority interests, calendarization, purchase price allocation, and other advanced topics that don't fit into a particular topic or perhaps fit into multiple of these topics mentioned right here. So what are the key challenges as we approach this case study? Well, first off, Yahoo has very messy financial statements. What I mean by that is that normally when you look at a company's financial statements, it's fairly obvious how you separate out charges like depreciation, amortization, stock-based compensation, and so on. With Yahoo, that's not the case, and we're going to have to spend some time upfront figuring out what those numbers are exactly, because as you'll see, they're not cleanly laid out, and if you just look at the financial statements, it's not at all obvious how you can even calculate EBITDA based on Yahoo's income statement and cash flow statement. There are other issues as well, such as the fact that despite having many different divisions, Yahoo does not cleanly separate its revenue and expenses by division. So its financial statements are quite messy. They also have a lot of other items that you don't always see with other companies, like equity interests, non-controlling interests, net operating losses. So they have a lot of different things going on here, and a lot of different segments that we're going to have to value when we get into the valuation segment of the course as well. Then there's also a lack of information in the filings. So compared to many other public companies, Yahoo does not disclose nearly enough information to build a fully 100% accurate operating model here. So in a lot of cases, we're going to have to make our own estimates and our own guesstimates for information such as number of employees by division. They don't include that type of information, so we're going to have to go through and back into our own numbers here based partially on their filings, investor presentations, and equity research. Another challenge here is that we're going to have wildly different projections. So when we look at equity research from Morgan Stanley, which we're going to use as our guiding resource going through this case study, they're going to have one set of numbers, and then Yahoo's own management team is going to have another set of numbers, and then other equity research analysts will have their own set of numbers. Now normally with companies, these are fairly close together, but as we'll see with Yahoo, they are wildly different because all these different groups had different expectations about their growth. So to deal with this, we're going to have to build in scenarios into our model, a base case, an upside case, and a conservative case, to deal with the fact that no one knows what's going to happen in the real world. No one knows what a company is really going to look like 5 years into the future. So the best we can do is come up with a couple different scenarios to model out different potential outcomes. And then finally, there will be new concepts. I mentioned before that we're going to be focusing more on mechanics, and that's generally true, but we will still be dealing with new concepts such as non-controlling interests, equity interests, calendarization, dealing with what happens when we don't have a clean closing date for a deal, for example. We're also going to be looking at different transaction structures in the merger model and LBO model course, and in the valuation course, we're going to be going through a few different methodologies, such as future share price analysis and liquidation analysis that you haven't seen before necessarily. So at the same time, you're going to have to be learning some new concepts as well, and as I mentioned, the pace here will be quite a bit quicker. So if you haven't already been through the Financial Modeling Fundamentals course or have the equivalent knowledge yourself, I would strongly recommend going through that because we're going to go fast here, and I'm going to assume that you already know all the information there very, very well. So what's the game plan for the first step of our case study, the operating model? Well, first off, we're going to go through and make sure that we actually understand Yahoo's financial statements. This may seem easy to you, but as I mentioned before, their statements, especially the income statement and cash flow statement, are not at all straightforward. The balance sheet is a little bit more straightforward here, but even there we will run into some unfamiliar items. So we're going to spend some time up front understanding their statements and how they all fit together and how we're going to adjust them for use in our model. After that, we're going to spend a couple lessons projecting their revenue. We're going to get a sense of overall what their revenue looks like, how they're actually earning money, and then after that we're going to project their expenses. Now, as I mentioned, we don't have the full data here in terms of employees by different divisions, so we're going to have to make our own estimates and come up with reasonable assumptions here for what these numbers might actually look like. Then we're going to combine the revenue and the expenses to actually build the full three-statement model. Now, as we build this model, we're also going to have supporting schedules like the PP&E schedule, the share price, dividends, and share repurchase schedule, and a number of other items like the working capital schedule as well. So we're going to have quite a few different items here that are going to be integrated into our three-statement model for Yahoo. And then finally, once we have those statements, we're going to link everything together and then create a summary tab. Then after that, we'll look at a couple other topics like calendarization, possible interview questions, and so on that relate to our operating model here. So that's a quick overview of the case study itself and then what we're going to be doing for the operating model. Now I'm going to jump into Excel and show you exactly how to set it up and introduce you to the inputs and assumptions page that we're going to be using for this case study of Microsoft and Yahoo. Okay, so now let's jump into Excel and see exactly what we're going to do here to set up our inputs and assumptions tab for this Microsoft Yahoo case study. So, if you've been through the fundamentals course, you've probably seen something like this before. If you've been through the industry-specific courses, you've also seen something like this. Basically, we're just trying to establish our baseline information for this deal. So, of course, our seller name is going to be Yahoo. Their ticker is YHOO. The last historical year will be 2007, because remember, we're going back to the 2008-2009 time frame. Our valuation date here is going to be January 30th, or actually January 31st, depending on whether we use the day the deal was announced or the day just before that. The buyer, of course, is going to be Microsoft. Their ticker is MSFT. The merger close date, the LBO close date, we're going to worry about these later, but I'm filling them in for now. The merger close date we're assuming happens a year and a half after the deal was initially announced, which is realistic for a deal of this size, around 40 to 50 billion. Definitely going to take quite a while for a deal like that to close. We have a few constants to find here, the months in the year, the conversion units. In terms of the color coding, just like the fundamentals course, we're going to be saying that blue indicates hard-coded numbers, black is for formulas or text, and then green is for formulas that are actually links to other worksheets. We have three different cases here, the base case, the conservative case, and the management case. The base case will correspond to Morgan Stanley and other equity research analysts. The conservative case will be our own estimate, a downside scenario for Yahoo, and then the management case will correspond to their own management's expectations. Very, very optimistic. They correspond actually to an investor presentation issued by Yahoo. So we're going to follow the numbers there closely when we come up with our own numbers for the management case here. The circularity and circularity breaker. This relates to something that you know about if you've been through the fundamentals and Excel courses on the site. But essentially in a couple places here, we're going to have circular references. Circular reference just means that the cell's output depends on what the cell's input is. So in other words, if I enter in cell I14, for example, that this is equal to I14 times I13, well, now I have a circular reference right here. Why do I have a circular reference? Because the cell's output actually depends on the cell's input. It depends on what the cell's value itself is. Now, in the real world, circular references are not actually this trivial and stupid. What actually happens in the real world is that we get circular references because of the interest expense and interest income calculations in a model. So I've built these in because oftentimes with these circular references we get ref errors, NA errors, and other types of errors that pop up in Excel. So we want to be able to flip on and off circularity, and we want to be able to hard code all circular references to 0 so that we can easily fix any errors. And so that's why we have these variables defined right here. In terms of other information, we also have the beginnings of our equity value and enterprise value calculation. Now, in this course, I'm not going to go through the difference between equity value and enterprise value because I'm assuming you already know that. Equity value represents the market cap of the company, and then enterprise value represents what you're really paying for it. So you're taking out the cash, you're subtracting cash and any cash-like items such as equity interest here, and then you're adding in debt, preferred, non-controlling interest, and anything else that you may potentially have to repay in the future, like capitalized leases. Now, in terms of actually calculating the equity value and where we're getting all these numbers from, I'm just going to show you quickly. To get the common shares outstanding, we simply look in Yahoo's latest 10K as of the time of this transaction announcement. On the front page of the 10K, we have their common share count right here, the 1.3 or 1.4 billion number that we have right down here, so that's exactly where I'm getting this number from. And then the current share price, we can pull this from Google Finance, we can pull this from Bloomberg, other sources, Yahoo Finance, really anywhere we can get this share price as of the valuation date. That's when we want the share price from. Now these other numbers, options, restricted stock units, and convertibles. So how do we know what to list here? How do we know where to get these numbers from? Well, one thing you could do is search the 10K, but a faster approach is to simply pull up the handouts that I've already created. If you pull up the one called options RSUs, what you generally want to do to figure out what kind of dilutive securities you have is to search for average effect of dilutive securities or just dilutive securities. If you search for that, you'll see that basically we have three things with Yahoo. We have restricted stock units, we have employee stock options, and then we have convertible notes right here. So it doesn't spell out exactly what the effect is. We could take these numbers as is. The problem is that these are averages over the course of an entire year, so ideally we don't actually want to do that. What we want to do instead is take this information and then go through and search the filings to figure out what the actual number of stock options, restricted stock units, and convertible notes are. So we're going to start by going through this filing and see where we can actually find these numbers here. So I'm going to scroll down. We get to employee benefits, and usually they have the information listed somewhere around here. And so here we have their stock option table. A way you can quickly find this is if you search for exercise price or weighted average exercise price in the filings. You can usually get the information right here. In this case, we're going to take the total option that's standing, so 180 million at a exercise price of 29.36. So that's where we're getting these two from. The dilution formula, we are just using the treasury stock method here. I'm not going to go through this because I'm assuming you already know how this works. Then for the restricted stock units, remember that restricted stock units do not have an exercise price. Instead, with restricted stock units, you assume that they just automatically add to the dilution. And so here, if we keep scrolling down, we can see restricted stock awards activity, and we see awarded and unvested as of December 31st, 2007. They're giving an average grant date fair value right here. Remember though, again, that with restricted stock units, they don't actually have an exercise price. They simply add to the dilution straight up. So you don't need to do anything. There's no treasury stock method here. So we're simply going to take this 30.227, the 30 million number here, and add it in. That's where this one is coming from. Then for the convertible, this one is listed in a separate spot. It is not listed in this employee benefits and compensation area. So what we have to do instead is go to another handout that I've created on Yahoo's convertible right here. If you search for convertible in the 10K, you can also find it, but it's on page 50. And they're saying right here it's a zero coupon senior convertible note, and they're giving some of the important information, the conversion price of $20.50. And they're saying the par value is $1,000, and they're saying that it needs to reach 22.55 for it to actually be converted. When it gets to that 22.55, it's going to be converted at the conversion price of $20.50 per share. So going back here, I've left out the dollar amount right now because we want to actually pull this from the balance sheet that Yahoo has. We do not want to just take it at face value and take the $750 million here because the value might have shifted over time, so we want to get it from the balance sheet instead. We do know it's zero coupon, meaning there is no interest, a 0% interest rate on these convertible notes. The number we're going to leave blank because that will depend on the dollar amount, but basically we're going to take that dollar amount, the par value, and then divide by the conversion price here, roughly, to get the number. And then to get the dilution, you can see the formula right here. As soon as we get to that $22.55 price, in terms of our current share price, then we're going to assume that the convertibles all become converted into common shares and simply add to our diluted share count right here. Otherwise, then we're going to assume 0. So that's the basic setup and where we get some of the information. A couple other things quickly to point out here. First off, in terms of your settings in Excel, if you press Alt-TO right now to go to Options, in Excel 2007, 2010, and more recent versions, if you go to Formulas right here, for the workbook calculation, you should set it to automatic except for data tables, and then you should also enable iterative calculations, set max iterations to 100 and maximum change to 0.001. If you don't do this, later on you will run into problems with your circular references in the model, so make sure you have this set up front. You do not want this to be set to manual. You could set this to actually automatic instead of automatic except for data tables, but later on the model will become quite unwieldy if you have it set to automatic, so I prefer to set it to automatic except for data tables. In Excel 2003 and older versions, this will look different. In those versions, you want to go to Options and then Calculations on the top instead of Formulas. If you go to Calculations, you should see a similar set of options, and make sure you have it set to automatic except for data tables, and then make sure that iterative calculations here are enabled. I've gotten some questions on color coding and how we actually enforce this color coding scheme. As far as I know, there is no automatic way to do this outside of writing your own custom macro or having your own macro installed. But one shortcut that you can use to do this is to press F5 and then Alt-S to go to Special. And then if you want to highlight all the constants, all the hard-coded numbers, you can press Alt-O. And then you can leave out text with Alt-X, logicals with Alt-G, and then errors with Alt-E. Then you press OK. And this will highlight everything. And then what you can do is go to your formatting in Excel, go to Control-1, and you can go to Font over here and change the color. Or in later versions of Excel, you can go to Alt-H for Home, and then FC for font color, and then you can set the font color automatically like that. Now, if you want to instead select Formulas, you can press F5 again, go to Alt-S for Special, and then F for Formulas, and here you can press X to get rid of the text. And then here you can see that anything in black, basically any type of formula that we have, is highlighted right now. So once again, once you have this, you can either press Control-1 and format it like that, or in later versions of Excel, Alt-H and then FC for the font color, and that's how you can format it. So again, no automatic way that I know of that you can actually use to format this, but there are a couple ways that you can use to actually select anything that's hard-coded or anything that's formula. Unfortunately, there's no way in Excel to automatically select anything that's a link to another worksheet, so that does require some manual work. Luckily, most of the time you're going to be dealing with blacks and blues rather than greens, so it's not a huge issue. So that's a quick overview of our Microsoft Yahoo Advanced Modeling case study, and then how you should properly set up your own Excel so that you can go through this case study yourself and make sure that all the settings are correct. Now that we've been through that, in the next lesson coming up, we're going to start by going through Yahoo's income statement. We're going to look at some of the trickier items and how to reconcile some of the items, how to figure out what the depreciation, amortization, and stock-based compensation look like. And then after that, we'll get into Yahoo's balance sheet, cash flow statement, and then go into some topics related to those.